Good day everyone. Covered in the chapter 1 is the overview topics in government accounting and accounting for non-profit organizations. So expect that the topics under this chapter will be further discussed by the succeeding chapters. Under this chapter, we will also discuss the following topics: the definition of government accounting as well as its four objectives, the responsibility, accountability, and liability over government funds and property, the responsibility of Commission on Audit, Department of Budget and Management, Bureau of Treasury, and other government agencies. Note that the government agencies are required by law to have accounting units, divisions, and departments. We will also discuss the financial reporting system of the national government. Also, the coverage and objectives of JAM for NJS, which was known as New Government Accounting System in 2002 and was replaced on January 1, 2016 as Government Accounting Manual for National Government Agencies. Covered also in this chapter is the basic accounting and budget reporting principles, the qualitative characteristics of financial reporting. One of my groupmates will also discuss the components of general purpose of financial statements and the elements of the financial statements, which for sure everyone of you has already been introduced from your past taken major courses and your past semesters.
Definition of Government Accounting pursuant Section 109 number of 1445, which states encompasses the processes of analyzing, classifying, summarizing, and communicating all transactions involving the receipts and disposition of government funds and property. So there are three main differences between government accounting and profit business accounting. First, responsibility, accountability, and liability. Government resources must be utilized efficiently and effectively. Accordance. When we say efficient, it refers to the things right. It means the government agency can deliver a given quantity and quality outputs within a minimum inputs. In the other hand, when we say effective, it refers doing the right thing, means the operating unit unable to achieve the expected result and contribute to the achievement of the organization role. The head of the government agency is directly responsible in implementing the efficient and effective utilization of government funds policy and is primarily responsible for government resources entrusted to its agency. So next, the objective of government accounting are the following: to produce information concerning a present condition, to provide basis for guidance for future operation, to provide for control of the acts of public bodies and office in the receipts, disposition, and utilization of funds and property, and report for the financial position and the results operation of government agency for the information of all the person concerned. Like the accounting for business entities, financial reporting for government entities also have the overall objectives of providing information that is useful decision making. However, it places the greater emphasis on the efficient and effective of utilization of government funds, in which the responsibility, accountability, and liability over the government funds and properties are imposed.
Accounting responsibility. The following offices are charged with government accounting responsibility. First, Commission on Audit or COA, Department of Budget and Management or DBM. Third, Bureau of Treasury or BTR. Fourth, Government Agency. Commission on Audit or COA. The responsibility of COA: promulgate accounting and auditing rules and regulations, including those for the prevention and disallowance of irregular, unnecessary, excessive, extravagant, or unconscionable expenditures or uses of government funds and properties. Second, keeps the general accounts of the government supporting vouchers and other documents. Third, submit annual reports to the President and the Congress on financial condition and operation of the government. Department of Budget and Management or DBM. The Department of Budget and Management is the primary government agency responsible for the formulation and implementation of the national budget through efficient and sound utilization of government funds and resources for the attainment of the country's development objectives. Bureau of Treasury or BTR. The Bureau of Treasury functions under the Department of Finance and it is the cash custodian of the government. The BTR is authorized to receive and keep national funds and manage and control the disbursement and maintain accounts of financial transactions of all national government offices, agencies, and instrumentalities. Government agencies. Government agency refers to any department, bureau, or office of the national government or any of its branches and instrumentalities or any political subdivision as well as any government-owned or controlled corporation, including its subsidiaries or other self-governing board or commission of the government. The government agencies are responsible in directly implementing the projects of and performing the functions delegated by the government. Each agency or entity shall maintain accounting books and budget registries which are reconciled with the cash records of the BTR and the budget records of the COA and DBM. Is the financial reporting system of the national government. Financial reporting is the process of preparation, presentation, and submission of general purpose financial statements and other reports. The objective of financial reporting is to provide information about the entity that is useful to users for accountability purposes and decision making. Entity refers to a government agency, department, or operating or field unit.
GAM for NGES. Prior to GAM, government accounting system was based on what we call New Government Accounting System until it was replaced on January 1, 2016. The NGES was promulgated primarily to harmonize the government accounting standards to international accounting standards, particularly the International Public Sector Accounting Standards or IPSAS. Since government accounting in the Philippines uses this what we call IPSAS, in which it was adopted as the Philippine Public Sector Accounting Standards or PPSAS in the preparations of financial statements. However, it is to be noted that the IPSAS are based on the International Financial Reporting Standards or IFRS. Also, the Government Accounting Manual for National Government Agency is promulgated by the COA under the authority conferred to it by the Philippine Constitution. The following are the objectives of the GAM for NGES. First, the standards, policies, guidelines, and procedures in accounting for government funds and property. Second, coding structure and accounts. Lastly, accounting books, registries, records, forms, reports, and financial statements. Basic accounting and budget reporting principles. The financial records and reports of government entities shall comply with the following. First, compliance with PPSAS and relevant laws, rules, and regulations. Second, the preparations of the financial statement is on the accrual basis. Third, budget basis for presentations of budget information in the financial statements. Fourth, it must follow the revised charts of accounts prescribed by the commissions on audit. Fifth, it must follow the double entry bookkeeping. Financial statements are based on accounting and budgetary records. And lastly, fund cluster accounting. In each of the principle, fund cluster is one of the basic accounting principles that government accounting being followed, by which in the government accounting, the books of funds are maintained by fund cluster or according to the type of funds being accounted for. As you can see, each respected funds following a code wherein 01 is for regular agency funds, 02 is for foreign assistance project funds, 03 is for special account locally funded or domestic grants funds, 04 is for special account foreign assisted or foreign grants fund, 05 is for internally generated funds, 06 is for business related funds, and 07 is for trust receipts. Therefore, it means that it has own books and separate reporting with the different funds classified per cluster.
Qualitative characteristics of financial reporting. The following are the qualitative characteristics or attributes that makes information useful to users. First, understanding. When users may reasonably be expected to comprehend the meaning of the information, it means understanding. Relevance. Information is relevant if it can help users evaluate past, current, or future events. It must possess predictive or confirmatory value. Materiality. It is material if the information contains an error that would affect the user's judgment decisions. Timeliness. If information is reported on time, it loses its relevance. Reliability. Information must free of material error and bias and not misleading. Thus, the information should faithfully represent transactions and other events. Faithful representation. It should be accurately presented in accordance with the substance of transaction and other events. Substance over form. It is necessary that they be accounted for and presented in accordance with their substance and economic reality, and not merely their legal form. Neutrality. If information is free of bias, it is neutral. Information shall not be selected or presented in a way that affects the user's decisions in order to attain a predetermined outcome. Prudence. Refers to the use of caution when generating estimates under uncertain situation, so that the assets or revenues are not overstated and liabilities or expenses are not understated. Completeness. Information should be complete, including materiality and cost. Comparability. Identify similarities and differences between entities and year on year.
Components of general purpose financial statement. General purpose financial statements are those intended to meet the needs of users who are not in a position to demand reports tailored to meet their particular information needs. The user of general purpose financial statements are the lenders, investors, suppliers, and customers. The complete set of components of general purpose of financial statements are statement of financial position, statement of financial performance, statement of changes in net assets and equity, statement of cash flows, statement of comparison of budget and actual amounts, and last is the notes, the financial statement comprising a summary of significant accounting policies and other explanatory notes. First is the statement of financial position. This is an example of the statement of financial position. It is used by business owners, investors, and management to quickly get an overview of financial strength and potential of a business. It is prepared at the end of the accounting period, which is typically 12 months. Next is the statement of financial performance. This is an example of statement of financial performance. It is a summary that shows the company's revenues, expenses, and net income. It shows the current financial status of your business, how cash is used, and where the unnecessary costs are. Third is the statement of changes in net asset or equity. This is an example of statement of changes in net assets or equity. It measures the changes in owner's equity throughout a specific accounting period. It shows the difference between total asset and total liabilities, resulting in the overall value of the owner's equity. Fourth is the statement of cash flows. This is an example of a statement of cash flow. It shows how much is gained and used during a given period of time. There are three main categories in the cash flows. First is the operating activities. These are activities of the business that is directly related to providing products or services to the market. For example, salaries paid out to the employees and cash collected from customers. Second is the investing activities. These are activities that generates or spend cash that is related in investing. For example, purchase of is the statement of comparison of budget and actual amounts. This is the example of a statement of comparison of budget and actual amounts. It shows the difference between budgeted amounts and actual result for a given reporting period. This enhances the transparency of financial reporting of the government. Is the notes to financial statement. This is an example of a notes to financial statement. It provides information in addition to those presented in other financial statement. Notes is used to explain the assumption used to prepare the numbers of financial statement, as well as the accounting policies adopted by a business or entity. It helps the users, such as financial analysts and investors, to interpret all the numbers presented in the financial statement. There are 5 elements of a financial statement. First is the asset. Assets are the valuable things that has cost and contribute to the day-to-day operation of a business. For example, cash, land, PPE, and etc. Key features of an asset are the benefits must be controlled by an entity. It means that the entity has the control to benefit from an asset or prevent others from benefiting from that asset. Next is the benefits must have arisen from past events or past transactions. Third, future economic benefits or service potential must be expected to flow in the entity. Indicators of future economic benefits. First, distinguish from the source of benefits. For example, physical resources is a photocopier machine. It is useful in the entity because it gives service by photocopying the papers in the business. Next, does not imply that asset is necessarily generated cash flow. The benefits can also be in the form of service potential. There are assets that is not cash generated, for example, building that owns by the entity but not for sale. Although it is not a cash generated, still it is an asset since it is used by the entity. And third, in determining whether a resources or right needs to be accounted for an asset, the potential to contribute to the objectives of the entity should be the prime consideration. A thing that can be listed as an asset that gives future economic benefit if this is owned by the entity or it is used in everyday operation of an entity. Fourth, the capacity to contribute to the activities, objectives, or programs. For example, PPE. This asset gives future economic benefits since it is used in the day-to-day operation or activities of the business. Fifth, the fact that an asset cannot be sold does not preclude it from providing economic benefits. So, what are assets that are not cash generated? For example, land that is not held for sale. Land is still an asset that gives economic benefits to the entity since it is used by the entity. Recognition of an asset. An asset is recognized when it is probable that the future economic benefits will flow to the entity, meaning asset is recognized if the asset will give benefits to the entity and helps the entity to achieve its goals. The asset has a cost or value that can be measured reliably. means that the asset is recognized when it has a cost or it is convertible to cash, or if not convertible to cash, it has a value or it is usable in the company's operation or activities. Probable inflow of future economic benefits. The chance of benefits arising is more likely rather than less likely. Benefit can be expected on the basis of available evidence or logic. Valuation method is free from material error or bias. A valuation method, this will determine the value of stocks of the company. That is why it should be free from error so that in preparing financial statements there will be no error as well. Faithful representation of assets benefits means that there should be accurate presentation of financial data and regarding the business condition. Reliable information will, without bias or undue error, faithful represents those transactions and events. By this, we can say that the information is reliable if there is no error and bias in presenting transaction and events in the business. Liabilities are present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits or service potential. Example of liability is accounts payable. Third is the equity. Net asset or equity is a residual interest in the asset of the entity after deducting all its liability. Revenue is the gross inflow of economic benefits or service potential during the reporting period. When those inflows result in an increase in net assets or equity other than increases relating to contributions from owners. Fourth is the revenue. Revenue is the gross inflow of economic benefits or service potential during the reporting period. When those inflows result in an increase in net asset or equity other than increases relating to contributions from owners. Contributions from owners or owner's contribution is what the owner invests to cover the business expenses either through personal funds or by transferring funds to a business account. Revenue funds comprise all funds derived from the income of any agencies of the government and available for appropriation or expenditure in accordance with the law. Last is the expense. An expense is the cost of operation that the company incurs to generate revenue. Distribution to the owners are future economic benefits distributed by the entity to its owners, either as a return on investment or as a return of investments.